Want to know how much a property is truly worth? Don't just look at the asking price. Look at the income it generates. That's the idea behind the income approach. This method is like a financial X-ray for buildings. It helps determine market value based on the cold, hard cash it can bring in. We're talking about apartment complexes, office buildings, shopping centers, anything designed to make money. The income approach relies on three key ingredients: net operating income, capitalization rate, and future income projections. Think of NOI as the profit after paying the bills. Cap rate is like the interest rate on an investment, and future income projections tell us what to expect down the road. This approach is like having a secret weapon in the world of real estate. It helps investors make smart decisions and avoid overpaying. Whether you're buying, selling, or just curious about property values, understanding the income approach is essential. Imagine you're buying a lemonade stand. Would you pay more for one that makes $10 a day or one that makes $100 a day? The answer is obvious. The same logic applies to real estate. The income approach recognizes that a property's value is tied to its earning potential. This method isn't just for houses. It's used to value businesses too. Think of it as figuring out how much a money-making machine is worth by analyzing income streams, expenses, and market factors. The income approach provides a realistic assessment of value. This approach is particularly useful for income-producing properties. It helps investors compare different opportunities and make informed choices. By focusing on income, it provides a clear and objective way to determine worth. In the world of investments, income is king. The income approach understands this fundamental principle. It says that a property's value is directly related to the income it can generate over its lifetime. Think of it like this. You're buying a stream of future earnings. The income approach helps you translate those future dollars into today's value. It's like having a crystal ball that shows you the financial future of a property. This approach recognizes that money today is worth more than money tomorrow. It accounts for the time value of money and provides a present value estimate based on future income streams. Let's break down the three pillars of the income approach: NOI, cap rate, and future income projections. Understanding these elements is crucial for unlocking the power of this method. NOI, or net operating income, is the lifeblood of income-producing properties. It's calculated by subtracting operating expenses from the gross income. Think of it as the profit a property generates after paying for essential costs. Cap rate, or capitalization rate, is like the interest rate on a savings account, but for real estate. It represents the expected rate of return an investor would demand for owning that property. A higher cap rate generally means higher risk, while a lower cap rate suggests lower risk. Future income projections are educated guesses about a property's future income based on market trends, historical data, and expert analysis. They help investors anticipate future cash flows and make informed decisions. Section 5. Applying the income approach, a step-by-step guide. Ready to put the income approach into action? Here's a simplified guide to walk you through the process. Step 1. Gather data. Start by collecting all the financial information about the property, including historical income, current rents, operating expenses, and vacancy rates. This data will form the foundation of your analysis. Step 2. Calculate NOI. Subtract the operating expenses from the gross income to determine the net operating income, or NOI. This figure represents the property's profit before debt service and taxes. Step 3. Determine cap rate. Research comparable properties in the market to determine the prevailing cap rate. This rate will reflect the risk and return expectations for similar investments. Step 4. Compute value. Divide the NOI by the cap rate to arrive at the estimated property value. This simple formula provides a powerful way to assess a property's worth based on its income-generating potential. Section 6. Practical uses, auctions and appraisals. The income approach isn't just a theoretical concept. It has real-world applications in various scenarios, particularly in auctions and appraisals. In auctions, the income approach helps bidders determine the maximum price they're willing to pay based on the property's income potential. It prevents emotional bidding and ensures that investors make rational decisions. Appraisers also rely heavily on the income approach when valuing income-producing properties. It provides an objective and data-driven method to determine fair market value, which is essential for lending, taxation, and investment decisions. Section 7. Navigating challenges, forecasts, and cap rate selection. While the income approach offers valuable insights, it's not without its challenges. Two primary hurdles are forecasting future income and selecting the appropriate cap rate. Predicting the future is never easy, especially in real estate. Market fluctuations, tenant behavior, and economic conditions can all impact a property's income streams, making accurate forecasting a complex task. Similarly, determining the right cap rate requires careful consideration of market conditions, property risk, and investor expectations. A slight variation in the cap rate can significantly impact the estimated value, highlighting the importance of thorough analysis. Section 8. Conclusion. Mastering the income approach. The income approach is an invaluable tool for anyone involved in real estate. By understanding its principles, investors can make informed decisions, avoid costly mistakes, and unlock the true earning potential of income-producing properties. Mastering this approach requires practice, research, and a keen understanding of market dynamics. By continuously learning and refining your skills, you can gain a significant advantage in the world of real estate investment. Remember, knowledge is power. The more you understand the income approach, the better equipped you'll be to navigate the complexities of real estate and make sound investment decisions. Section 9. Disclaimer. I'm Dave Ramsey, personal money management professional, and now, apparently, a real estate expert. Just kidding. This information is for educational purposes only and shouldn't be considered professional financial advice. Consult with a qualified professional before making any financial decisions.